Welcome to the Inside Out Money Podcast.
Can't even recognize this place. Too many pieces of our past mistakes.
Hi, I'm Maggie, and I believe real change starts from the inside out. So let's work together to improve our money and our lives from the inside out. We will explore all things money and our relationship with it. Join me each week with a rotating set of co-hosts, friends, and interviews. Let's jump in.
This time, we going round and round and round and round and round.
Hey, Andrew.
Hey, Maggie.
You are a champion. Like you look more championistic than you did the last time we recorded. I'm expecting like more from you this week, you know?
A lot of expectations here.
Yeah. So Andrew, before we jump into today's topic, Andrew won the Gran Fondo Nationals you'd think he won in like the Master. This is a cycling race, like a big deal cycling race. And you're like the fastest in your age group.
Correct.
But you also won it outright this time. Have you ever done that before?
I have.
The
last 3 years, I've won the outright.
I don't know why I thought you were only winning in your age group.
That's for all the other races. It's age group only, but the Fondo is unique in that you're racing with everyone together, and so you have the opportunity to win the outright. Yeah. Yeah.
I mean, I'm telling for other people because you were there, Andrew. But like you were on the podium as first place for the all age groups with like two. Basically kids. They look like they're teenager. One of them was a teenager.
Yes. He just turned 18 and the other one was 20. So yes.
Like just little kids. And that's because how old are you?
46, about to turn 47.
That's pretty impressive, dude. I'm just going to further give you some compliments of like, you're holding down a full-time job. You're not even early retired yet. Holding down a full-time job, doing a podcast on the side. You got kids and a family and all sorts of other commitments in life. And you're like a badass cycler that's faster than all the other kids in the US. So it's pretty cool.
Thank you. I appreciate that.
I appreciate you giving a little bit of your leftover energy to Inside Out Money. So
always enjoy these conversations.
Yeah, I agree. So we're going to talk today about, well, first off, like in case you thought this was a cycling podcast, welcome to Inside Out Money. This is actually a personal finance podcast focused on redefining wealth from the inside out. Every week, I speak with a rotating set of co-hosts about a different financial topic that helps you improve your financial mindset and tactics. Today, we have co-host Andrew, and you know Andrew and I like to talk about investing stuff often. And we're actually going to like kind of go back. In a way, this is like back to the basics, but this is also a level of detail that some people don't ever really need to understand, but is actually important, I think, to understand. We're going to like cover a lot of investing terms and terminology and like what they mean. And I don't know about you, Andrew, but like I've encountered a lot of friends and family and coaching clients lately who they're like sold on the index fund philosophy and they've listened to some of our past episodes on it, but they get into the actual, like they get into Fidelity and they're like, okay, I'm trying to buy it. And like, I'm getting asked, is it a market or a limit order? My brother was asking me something about the difference between an ETF and a mutual fund. And did it matter the other day? And so I just think there's like this like taking a step back to just explain some things about how the stock market and investing and everything works, not to overcomplicate things, but really just to educate people and help you understand like what you need to know versus what you like you'll learn because it's interesting, but you don't really need to understand every bit of this.
Yeah. And even on some of these concepts, you may not actually be investing in them, or it may not be relevant, but it's good to know for your own personal situation, but it's good to know what is out there so that if it comes along, it's kind of like what not to potentially go towards and at least understanding it.
I agree. And as we're covering these things, we'll give you our opinion on whether you really need to kind of sort of sweat these levels of details or not. But again, I think it's like understand it and then move on to, is this something that I really need to worry about, day to day as I'm, managing my financial life?
Right.
Okay. So should we start with like a breakdown of the different types of investments that are out there?
Yes. Maybe we should start with a disclaimer before we jump in.
Oh, yeah. Lots of disclaimers. You're a cyclist.
Things we talk about here, Maggie and I are not professional advisors. and that this is for entertainment purposes only, and these are only our opinions, and we would never make any specific investments advice on this.
Yeah. And we're also not going to cover everything. We actually might turn this into a 2-part episode, but even in the parts we cover, like, we're just scratching the surface, right? You could do an entire episode on every single thing we're going to discuss today. So we're going to talk about some of the most important stuff we think you need to understand as a sort of 101, 201 level. And we won't get to everything because everything would take forever. Okay, so let's get to what we can get to. Types of investments.
All right. We'll start with stocks and bonds. That's the ones that people kind of always will first start with. On the stock side, you've got publicly traded companies, and when you purchase a stock, you are purchasing a tiny, tiny sliver of that company, and you are an owner when you own the stock in a publicly traded company.
Yeah, you heard Erica joking on a recent episode of, like, she owns the Atlanta Braves. You know, she owns one share just for fun of the Atlanta Braves.
And all of these, all the publicly traded companies, you know, there are markets in the U.S., the big ones being the New York Stock Exchange and the NASDAQ, and then also there are all the international exchanges, which, you know, there are tons of those, and there are companies all over the world that are traded on their own individual exchanges. So it's not just the U.S. Obviously, we're in the U.S. We have a very U.S.-centric approach, and a lot of talk, especially in the media, is just about the New York Stock Exchange and the NASDAQ, but there are literally hundreds of other exchanges around the world where stocks are bought and sold every single day.
Yeah. And stocks are one of the best ways that you can build wealth over time. And again, it doesn't mean it doesn't come with some level of risk. Their value can fluctuate based on, you know, how the company is performing, based on market conditions, based on things that people can't even quite put their finger on, right?
Mm-hmm.
Even some of the best economists in the world cannot explain why the stock market goes up and down in response to certain things. But it is one of the best ways you can grow your wealth long term. So when you think about, like, the FIRE community or financial independence community, a big thing is spend less than you make and invest the difference. And you invest it in a stock exchange.
All right. So next one is after stocks. Next one people usually turn to is bonds. You want to take that one, Maggie?
Yeah. So bonds are a type of investment where you are actually, like, you're buying it just like you're buying a stock. But what a bond is you're essentially lending money to the government, a company, or some other entity for a set period of time. In return, that issuer actually promises to pay you some level of interest at regular intervals, and to return the principal amount to the original loan when the bond matures. And there's all sorts of, like, bond funds. And so you don't actually see all of the inner workings of what I just explained happening. Also, you could buy, like, a treasury bond, and you would actually be very clear about, you know, what percentage you're going to get paid and when and all that. But there's a lot of other bond funds where you don't necessarily know all the inner working details of what's happening with each individual bond within that fund. They're generally considered much safer investments compared to stock, typically offer a more predictable but often significantly lower returns. A lot of people use bonds to diversify their investment portfolio and to provide a more, like, steady income stream. And there's all these formulas of, like, what sort of, you know, bond versus stock mix you should have based on your age. We're not going to get into that. I don't even, you know, we can kind of talk about our beliefs on it, but.
So I love the way J.L. Collins positions bonds in The Simple Path to Wealth. He refers to it as ballast. It adds some stability to the portfolio and helps smooth out the peaks and valleys a little bit. You may have a little bit lower of an overall return rate, but it helps to provide a more stable portfolio. And so, you know, I personally don't own any.
I was just going to ask, like, what kind of bond mix you've got.
Yeah. I am in my 40s and I'm investing for the long term. And so the market volatility over the next 10 years does not concern me. I'm investing for 20, 30, 40, maybe hopefully 50 years. And so the returns that you can get through stocks and equities is typically better than bonds. And that's why most early retirees are focused on stocks, but more as you get further along in your retirement, or if you are retiring, in your 60s or 70s, people will typically add bonds to their portfolio to provide some ballast. And over shorter horizons and shorter periods of time, a mixture of a stock and bond portfolio can outperform an all stock portfolio. And so that is the benefit of that. And it's one of the reasons why J.L. Collins recommends pretty sure it's 75-25 in his book. He recommends 25. Don't count me on that. I don't have the
Which
book in
again,
front of me.
you're not following, right?
Correct.
And neither am I, right? Because
And
I'm the same boat as you. I'm in my mid 40s.
Yep.
I'm playing the long-term game here, and we'll get into some target date funds later in this episode, but like if you've been carrying a lot of bonds, you were significantly underperforming. Yeah.
And the other interesting thing about bonds is that the way typically over the last couple of decades, bonds have performed inversely to stocks. And so that is what has driven some of the bond market is that when your stocks are down, your bonds are up. And so it helps to counteract that.
And it's what's driven those recommendations.
Correct. But what's interesting, what's happened in the last couple years is you've seen, bonds have had a terrible run in the elevated interest rate environment that we've seen for the last couple of years. Bonds have performed extremely poorly. And so that has had people rethinking that is not always the inverse of stocks. The other thing with bonds, just that sometimes people struggle with in the concept, is that the prices of bonds move inversely to where interest rates go. So as interest rates fall, bond prices go up. The value of that bond is more because you secured your interest rate when you bought that bond at a certain amount. And if the rates fall, that bond now becomes more valuable. The same is said if you buy a bond in it and then the interest rates rise, like what we've seen for the last couple of years, and this is why bonds have performed so poorly. Interest rates were at 1-2, what was the Fed funds rate was super low, right? 1 or 2%. And so as rates have increased, the value of those bonds has dropped dramatically because people could get a much better interest rate in the current market versus where people bought those bonds. Bonds have maturity rates anywhere from 1, 3, 5, 10 years, right? There are all different types of maturity rates. So if you buy a 5-year bond and if you bought it 5 years ago and suddenly the interest rates have gone up dramatically in 5 years, not a whole lot of people want to buy the bond that you had from 5 years ago when interest rates were 1 or 2%. So the value drops on your bond. And so that's why bonds have had such a tough time in a increasing interest rate market like we've seen.
Yeah, that's interesting. Okay, so that is a bit about stocks and bonds, which are two of the core types of investments. There's also real estate, cryptocurrencies. There's a bunch of other things that we're not going to really get into today. We really want to focus on not just the basics, but where we recommend keeping your money. So I think the next thing that is helpful to explain is the concept of what index funds are, what ETF funds are, which are exchange traded funds, and what mutual funds are, and why it matters. And I think just to cut to the chase here, like it's important that you understand the difference because it's important that you understand this stuff. But in my opinion, you should not sweat the details of what we're going to talk about as a long-term investment. You're not like a day trader. So some of this stuff isn't going to matter to you. And I know it feels like a weird thing to say, like what I'm about to say doesn't really matter to you. I think what the point I want to make is I don't want you to get overwhelmed by this, right? I want you to take this as like, you're clearly interested in improving your financial knowledge if you're listening to this podcast, and do that, but don't sweat that you need to worry about going and looking at everything you're holding and whether it's an index fund or an ETF or a mutual fund and all of that.
Yes, I 100% agree with that. And I always like using an example here. So VTSAX, which we have talked about a lot on here. I'm a huge fan of VTSAX, which is the Vanguard Total Stock Market Index. And VTSAX is a traditional mutual fund. It is settled once a day. it does not, the price does not fluctuate within the trading day. And so basically the price of VTSAX is established at the end of the trading day every day. And then if you buy that day, you could buy it at 1:00 in the afternoon, you get the closing price of that day. And so the alternative to that is VTI, which is the Vanguard Total Stock Market Index, but it's set up as an ETF. And that trades more like an individual stock where there are price fluctuations throughout the day. But ultimately, it really does not matter which one you are in. And some people like to have that. There are some pros and cons, which I would argue mean very little for the long-term investor.
Yeah.
And if you said you were in VTI or if you said you were in VTSAX, from my perspective, it really does not make a big difference. Yes, there are differences, but the important thing is they really don't matter. And it's much more, don't let that decision prevent you from investing. And that is a level of complexity that is not worth the time to think about it. Pick one and go with it.
Exactly. So, and it is a personal story of why it does and doesn't matter, right? It matters that you know enough to talk about this, but it doesn't matter what you have. And so here's the story. A long time ago, this was right when I started Friends on Fire podcast, I think I was talking to my mom about something and I was talking about investing in FZROX, which is FZROX, which is a Fidelity version of VTSAX. And it's also considered an index mutual fund. And my mom was like, well, I mean, your uncle said I really should be investing in ETFs. And I was like, no. I don't know why he said that. And she was like, well, something about because it trades throughout the day. And I was like, yeah, but you're not a day trader. Who cares? You're never going to be trading throughout the day. You're, again, a long-term investor and you don't care about the difference between an ETF and a mutual fund for what you're trying to do. And neither does 99% of the world. Right. Mm-hmm. And so that to me is an example where it's you need to understand the difference so that when someone pushes back at you or tries to confuse you about something, you know that it doesn't matter which one you're doing, right? Mm-hmm. Right. And so I think it's also worth explaining. So an exchange traded fund, Andrew explained, one of the biggest difference between ETFs and mutual funds. And that's that an ETF does trade throughout the day, kind of like individual stocks do. And you can buy and sell them throughout the day. And there are, tons of different prices and the price fluctuates based on supply and demand. Also, ETFs are passively managed. So they're tracking some sort of an index. And that's why they're really low cost also. That's why usually an ETF or an index fund are really have a very low expense ratio, which we'll explain a little bit more about what an expense ratio is. But that's why they have such a low expense ratio, because they are passively managed. They're tracking an index, which could be the overall stock market, or it could be like the energy sector or something like that. Versus a mutual fund is actively managed. Right. And so as a result of it being actively managed by some sort of a fund manager, by whoever runs that mutual fund, the fee is higher. So ultimately, you are paying a higher fee. Now, the thing that's worth clarifying, because Andrew, you started with examples of VTSAX, they're actually index mutual funds. So there's also an index fund. So we talked about ETFs, we talked about mutual funds. There's also something called an index fund, which could be structured as either a mutual fund or an ETF. And they are also passively managed like an ETF. So you can have something like FZROX or VTSAX that are an index mutual fund, which means they're passively managed. So they're trying to replicate the performance of the specific index, which in the case of VTSAX or FZROX is the total market, total US stock market. And the most important thing you need to really understand there is just that trading difference and then the pricing structure because of the management style. Then there's also a bit of differences in the tax efficiency of these different types of products. So ultimately, technically, ETFs are more tax efficient because there's less frequent trading happening within the fund versus a mutual fund. There's more frequent trading happening because it's actively managed. And so there's again, to me, as an average investor, you shouldn't really be worried about that level of detail. And so I don't sort of worry about that piece specifically. I more really focus on, I really focus on wanting a low expense ratio.
On expense ratio, it's what the firm charges you for managing the fund. And so expense ratios can vary dramatically. You've got Vanguard funds, well, you have Fidelity funds, which have no expense ratio at all. They
to be clear, they have like 5 or 6 specific funds.
5 or 6 specific funds
zero.
that are considered actually zero. So it goes all the way from zero up to some funds can have crazy high 0.8, 0.9
close to
expense
1%.
ratios, right? Close to 1%. For example, VTSAX is 0.04. VTI, the ETF version of it, is 0.03. So that has a slightly lower expense ratio.
Which tends to be about as low as it. I mean, zero is as low as it goes, I guess.
Yeah.
But if you take out the Fidelity zero fee funds, which by the way, you're locked into Fidelity with. So the one downside of those is you can never move that fund anywhere else because it's Fidelity that fund is proprietary to Fidelity, which again is not a terrible barrier because,
Yeah. And in the same way we've talked about how fees matter, the expense ratio is essentially the fee. And it might not sound like a lot. Oh, well, I'm only giving up 0.5%, or I'm giving up, Wealthfront or some of the automated ones are typically 0.2, 0.3. And
it adds up.
Probably a lot. If you were to take a typical portfolio of mutual funds, you might see an average expense ratio across all the funds in someone's account of being 0.7, 0.8. But over 10, 20, 30 years, those fees definitely add up and impact the returns. And it's why you and I have always been such big believers of low expense ratio index funds, because you're getting the market returns.
Yeah. And again, that's why it's important to understand this, because you heard us say that VTSAX technically is a mutual fund. It's an index mutual fund, but it has a really low fee. So you don't really care about the fact that it's a mutual fund because it has a low fee. What you want to watch out for are mutual funds that have a higher expense ratio, because they typically do have a higher expense ratio because they are actively versus passively managed.
Mm-hmm.
So then this is one of my things that I get like real fired up about lately. I want to talk about target date funds. Do you own any target date funds, Andrew?
I don't. I've had access to them through either my 401k or actually the 529 plans. I've got a bunch of. That's typically where a lot of people will use them. I think you've got a story about that, right?
I do, yeah.
You had them in there. I've had access to them. Some people really like them. It's a very hands-off approach. I've found that they are typically too conservative. So even for somebody in like their 20s or 30s, if you were to select when a target date fund is, for example, your child is born, they'll be going to college in 18, 20 years, right? So 20 years from now, so you could buy a fund that is a target date fund of 2044, right? 20 years from now, and you'd buy into this fund. And then the thinking is that over time, most of the target date funds will gradually go from a more aggressive approach to a more conservative approach as you get closer to the end date of the fund, either your retirement or your kid going off to college, something like that. But what I've found is that most of them are too conservative in their glide path to that.
No way.
And that
the bond mix is
right.
Super
They'll
high.
start you off even at like 90-10. And so I've taken a more aggressive approach where I like to have focused on 100% in equities versus having any bonds. And so that's the challenge.
So just to really like hit this point home for people, in your 401k, usually you're going to see these options in your 401k and in your 529 college savings plans. And they will literally be called, like, sometimes it'll have a brand name before it. It'll say like Vanguard Target Date 2045 Fund or Vanguard Target Date 2030 Fund. And they have them for like, almost every 5-year kind of time period, sometimes every individual year. And they are much higher fees, significantly higher fees, because again, you're paying for two things. You're paying for the individual fund. There's a lot of times it's not individual stocks within them. It's a bunch of other funds within them. And you're paying for the expense ratio of those funds. And then you're paying for the expense ratio of the management of that overall target date. So the expense ratio they show is both of those added up together, but it can often be like half a percentage, which again, that's like half of what you would pay a financial planner, which we don't think is a good idea. And we've got a whole episode where we tell you why. We'll put it in the show notes. But it's not like you're paying a higher fee and you're getting a really, really conservative, significantly lower performing asset as a result. And so to me, it's like the downside and the downside, right? There's not a single, the only good side is that you logged into your 401k and there was an overwhelming amount of choices to choose from. And it gave you one thing that kind of made sense in the moment, right? But I would really challenge people. I mean, back to the disclaimer at the beginning here, like we're not giving investment advice. We're giving our opinion. This is for entertainment purposes, but we do not invest in target date funds. And everybody, every friend I ever do any sort of financial advice for, which is fairly frequently, first thing I do is I open their 401k. I look at the target date fund. I show them, I just showed somebody this the other day. I was like, look, the fund you've been in has performed 25% growth over the last 5 years. And I was like, that they're like, oh, that sounds good. I'm like, well, here's why that's not good. If you had been in VTSAX, you would have had 60% growth over the last 5 years.
Yeah, they're somewhat designed for the completely hands-off approach, right? Somebody who does not log into their 401k site for 25 years.
Yeah.
So I would find that surprising if that was someone's approach. But there's also the flip side where some people will have cash sitting in their 401k, right? They didn't even allocate it to a fund. Like that's a big mistake that people make in their IRAs or their Roth IRAs or their 401ks where
it's better than that. You're right.
Right. It's better than that, but it's not, I think it's not that difficult to manage it yourself, and it's not typically not worth the fees.
Yeah. And to be clear, to manage it yourself is go into your 401k or go into your 529 and find, they have a like set of funds, a limited set of funds they offer you based on the setup with whatever brokerage you're using. Find the one that's closest to VTSAX. That's basically a total market index fund is what you're looking for. And maybe back to the bonds point, maybe you want to mix it with a bond fund at a certain percentage, but you can pick a couple of funds that basically give you total market returns and ditch those target date funds.
Yeah. And unfortunately, a lot of the 401k providers and 529 providers don't offer a total stock market index fund, but almost everybody will offer at least an S&P 500. So that's the one. Either look for a total stock market index or the S&P 500. I've never logged into an account and not seen at least an S&P 500 fund off.
Well, I actually have.
You have?
That? Yeah,
No.
Because I've been helping a few people lately and they did not have anything that was the equivalent of, that was a total market or that was an S&P 500.
I mean, that is just criminal on the employers and the providers.
For what it's worth, two different companies recently, friends and two different companies, and they were both big, large, one was a large law firm and one was like a large tech firm.
And what's so crazy about that story is that the company is deciding what funds are offered, and for them to not offer, and this is one of the problems is there are big incentives on the backside, right there, where fund companies will offer companies incentives to offer certain funds, and that is not ideal.
And like higher fee funds.
Mm-hmm.
So as an example, if you find that your company is one of those companies that doesn't offer even an S&P 500 fund, what they always have is a selection of large cap, mid cap, and small cap funds. And you can kind of make your own mix of like large cap and mid small cap, which is what I did for someone recently. Right. I was like, look, here's the mix in VTSAX of large cap versus small cap. And so buy these two funds
a good strategy.
And
I like
do it
that.
at like these two mixes. And then I went and looked at like what the performance of those two things, would have been over the last 5 years. And it would have, significantly outperformed the target date fund.
Yeah.
Okay. So I think the last thing we will finish up with is a group of terms and things that you want to understand when you're actually going to buy these funds. Because again, we talk about this all the time. We have multiple episodes about why low cost index funds or what we invest in and why and all that. But I've just talked to so many people who, again, get into the process of actually going to buy it and get like stuck on all the screens and the choices and all of that. So let's start with the actual brokerage or broker. So the first thing you need to do to buy any of the things that we just talked about is you actually need to work with a broker, which would be, and that's not a person, that's a company, right? Certainly like a financial planner would sell you on like, oh, you just work with me, but all they're going to do is set you up with a brokerage account somewhere, either at their firm or somewhere else. And so again, we have an episode on why you don't need a financial planner and then how to break up with your financial planner. And we'll put links in the show notes to that. But we think you should be working directly with a brokerage firm like a Fidelity, a Vanguard. Those are our top two favorites, I would say. And there's also, there's Charles Schwab, there's and E-Trade. I mean, there's tons of them.
Lots of them.
But I think between Andrew and I, we'd say like, if you were starting from scratch, you choose Fidelity or Vanguard.
Absolutely. Yeah.
You can't go wrong with either one of those.
As a John Bogle fan, Vanguard is my... Andrew's
Vanguard. You know what's funny though? I set someone up. I sat there with a coaching client.
Yeah.
I set them up on Vanguard the other day. We had a lot of trouble.
The web experience on Vanguard could use a little improvement.
Fidelity is way I mean,
easier.
Andrew and I spent our careers working on websites and in the digital marketing industry. I was like embarrassed that I only suggested Vanguard to them because they already had their company 401k was with it. So I was like, well, let's just do Vanguard. And it was a pain in the butt. And then their customer service, their 800 number.
Not good.
We got so frustrated with. It's one of those that like sends you through a million prompts. And like you can't, it's really hard to speak to someone. Fidelity, fantastic customer service, very easy to speak with someone. But that being said, I don't think you can go wrong with the other two. I was just a little disappointed in Vanguard.
Good to hear.
They do have great low-cost funds, though.
Yeah.
Okay, so you need to set up an account with one of those, or again, another firm, to be able to buy, sell, own index funds, ETFs, mutual funds, individual stocks, anything like that. So you set up an account, doesn't cost anything to set up an account. There's also like robo-investing firms that offer services at brokerages, which there's firms that are like Wealthfront, which we've talked about in previous episodes. I'm a big fan of Wealthfront for high yield savings accounts, and I used to use Wealthfront for robo-investing early on before I understood how simple low-cost index funds were. And I no longer even wanted to pay the 0.25% to Wealthfront. So Greg and I did a whole episode about why we were leaving Wealthfront for investing and how much we were going to save over the next, 30 years on that. And I'll put a link in the show notes to that. But they do charge a small fee, and basically they're automating your portfolio similar to target date funds. They're kind of doing it at a risk level based on you. They're doing some level of tax optimization or tax loss harvesting. But ultimately, I don't recommend that, and we don't think you need that. But I just want you to be aware that that is a service that many brokerages, like even when you sign up with Fidelity and Vanguard pitches you pretty hard at the beginning of signing up for their managed services. And so you don't need that, just to be clear. That's an important connotation. You just want to set up a free account. There's no fees involved. You really don't even want to be buying anything that involves fees because, like, for example, if I try to buy VTSAX through Fidelity, there's a fee on it. So I don't buy that fund because there's 100 other funds I can buy that have no fee associated with them. And so most of the things you're buying, you should never incur a fee for other than that expense ratio, which we talked about. Okay, so you've opened up an account, you've tried, we've convinced you of something, you're going to go buy some VTSAX or some VTI or whatever it might be, and you're going to hit a screen and it's going to ask you like how many shares you want to buy or the dollar amount you want to buy. Then it's going to have a little like option or toggle for, do you want to do a market or a limit order? And that's when a lot of people are like, what am I supposed to do? And they just stop. Andrew, what are they supposed to do here?
Well, it depends on the type of asset you're buying, right? If you're buying a mutual fund, it won't make a difference because it just settles at the end of the day. If you're buying
because there's no
like intraday, there's no intraday
trading,
right? But if you are buying an ETF or you're buying an individual stock, or you might have some options or some restricted shares you're trying to sell, the difference between a market and a limit order is the market order is whoever your broker is, they're just submitting it at the time that you hit the submit button or you confirm the trade via phone. They just submit the order to the market, and whatever the price is when they submit it is what gets filled. Whereas a limit order, you actually set the price that you're either willing to buy or willing to sell. So if the stock is trading at $85, you put a limit order for 90, and if it reaches 90, you're going to sell. And so it will wait until the market conditions hit that specific criteria, either up or down.
And that's if you're selling it. But if you, a lot of times people get confused on if they should click limit order for buying. And so in that example, let's say the price is, $101 and you think there's a Fed announcement, something's going to drop and you want to get a deal. You could say like, if it goes down to 100 today, I want to buy 50 shares.
Correct.
And then if it never gets down to 100, it'll just cancel your buy. And if it gets
never
to 100,
executes it.
it won't execute it. And if it gets to, if it goes down by a whole dollar in a day, which is a lot.
Think of a limit order as a simple trigger.
Yeah, like a bid.
Right. If the market conditions trigger your condition, then it executes the order.
But the trick with a limit order and why I think you should be careful here is I was having this conversation with my brother. He was like, well, I want to get it at a discount. He like put in a real low. And I was like, well, do you want to get it today? Because you're not going to get it at that price. So if your goal back to the time in the market is more important than trying to time the market, I do think it's often like I sometimes, will put in a limit order, especially if I'm just looking to like put some extra money in or something. But with automated buys, I'm just doing market buys.
Yeah,
right?
I never, the only time I ever have a question about market or limit is if I've got options or restricted shares that I'm dealing with. Pretty much all of my regular investment activity is all dollar cost average and it's all set up automated. So essentially it's by default, it's mutual fund at the end of the day. So it really doesn't make a difference. But I definitely do see a lot of people stressing on the market and the limit and trying to quote get the best deal. And just remember, you're trying to time the market at that point, right?
Yeah.
So
and you're trying to time it within a day. We don't recommend you try to time it within years. Yeah. And so look, this is another thing where it's like, it's important for you to understand the difference so that you realize the difference doesn't matter to long-term investors, right? And so click market, call it a day and move on with things. But Andrew, you just said dollar cost averaging. Can you explain that to people? I think that's another term people should understand. Yeah.
So dollar cost averaging is where you're continually putting money into the market and you're averaging the cost that you're acquiring that asset over a period of time. And so I have investments set up for every 2 weeks or every month. Some people will do every week, but you set up automated investments that will buy BTSAX every single month. And then you'll have those buys done. You'll do 12 buys over the year. And essentially you've averaged the cost of your purchases across those 12 months.
Yeah. And so you also, a lot of people, if they I've heard a question a lot about a lump sum of money and what do you do with a lump sum of money? So my version of dollar cost averaging mostly is I'm just doing automated weekly buys. But if I did have a lump sum of money, I would chunk it up into, actually this happened when I moved my 401k, when I left IHG and I moved my 401k over. Some weird stuff was happening in the market right while I was transitioning my entire life savings of a 401k. Yeah. And so I moved brokerage, so I had to rebuy new assets. And I didn't want to go in on one day and buy it all at that price. So I dollar cost averaged my way in and I split it up into 6 or 7 big chunks and just bought it over the course of a few weeks. And it made me feel better because I was like, well, I'm not stuck in at one price on one day for this big chunk of money.
This is the case where feelings and math don't always add up together, right? So the math would tell you that time in the market always wins and that any type of investment you make should be lump sum. Yeah. I actually take a little bit of a different approach in the same vein where, people would say that the math always wins in not paying off your mortgage, but it makes you feel a little better. And there's definitely some risk mitigation by dollar cost averaging a lump sum, but just know that the math absolutely clearly shows that putting it all in is statistically better, but you have potentially bigger swings based off of how the market performs. And people hate that feeling of, I just invested a big chunk of money in the market. Just look at what we've seen in the last 3 months, right? If you had invested a big chunk of money or either way, right? Either selling or buying, but typically on the buy side and the market tanks, that doesn't feel that good. Whereas if you've dollar costed it, it makes you feel better. And behavior is a big part of personal finance. And so I have done it both ways. I have definitely dollar costed some lump sums to make myself feel a little better, and other times I've just put it all in. And I think the size of the investment matters here, right? And so I've taken that approach. But I think as I've gotten a little bit older and wiser, I probably will lean more towards the lump sum approach.
Time in the market.
Right.
Yeah.
Time in the market.
Yeah. I struggle with that myself. I think I posted on Instagram this week, actually.
Yes, I did see your Instagram.
The money
post
I've
this
been
week.
sitting on since retirement,
Right.
waiting for
Yeah.
this, correction or crash that everybody's
Yeah.
been talking about for years.
For
Meanwhile,
decades.
there's
right?
been solid performance that I missed out on.
It's pretty nuts. After reading your Instagram post, I went back and looked at the VTSAX performance for the last year and 2 years, and I was like, wow, yeah, it's pretty incredible what it's done in just a year. Yep.
Yeah.
I've had some money on the side as well, so I feel your pain a little bit on that.
And then you're like doubling down. You're like, well, I've waited this long.
Right. Market hit an all-time high this week, right?
I know.
And so,
Yeah. Okay, so the last thing we're going to cover, and then we'll wrap this up, is let's talk about dividends, because I also get a lot of questions about this. So dividends are something that stocks sometimes pay out. So you'll hear this term, but it's a portion of a company's earnings that are distributed back to shareholders. So they can be paid out in the form of cash or additional shares. That's actually a selection you make within your brokerage settings, or within Fidelity or within Vanguard or whatever broker you use. Often it defaults to reinvesting dividends. So you may not even realize they're getting paid out, but you can change. Actually, Greg and I recently in early retirement decided it's already taxes we're paying. So we were like, we'll take the cash and decide what to do with it. So we have all of our dividends paying out to us now, and they can be paid out quarterly. Some companies pay them out like monthly, semi-annually, annually. It just depends on the company and the stock and the fund. And again, if you have an index fund, you own a ton of different stocks. So it depends, what all those stocks are paying out. But ultimately, dividends are a way that companies are sharing their profits with investors and providing some sort of a kind of income stream to shareholders. Not all companies pay dividends. There's actually funds that are focused on like high dividends that are, what do they call them? There's like mutual funds and certain funds that are a collection of stocks that typically pay out higher dividends if that's something where you're looking to, particularly focus on stocks that pay out big dividends. And then there's other companies that just don't pay out dividends and instead decide to reinvest back into their own business.
Right. It all comes down to an individual company's capital strategy, right?
Yeah.
And high growth companies are not going to be paying out dividends. They're typically going to be reinvesting into their own business. So historically, tech companies have shied away from issuing dividends, although Apple has recently changed that approach. Apple is now issuing dividends because they have not been able to, they're generating tons of cash and they are sharing that now with their shareholders. You look at a much more traditional low growth company like an AT&T or a quote old school manufacturing company, those are more likely to be paying dividends. On the VTSAX or an S&P 500 fund, they typically pay out about 1.5% a year in dividends. And like you and Greg, I also have recently changed my dividend strategy. And I always used to have dividends checked, but
You mean reinvested?
Yeah, dividends reinvested. I had the checkbox checked to have dividends reinvested. I recently unchecked that box to have dividends paid as like you're already paying the taxes. And so it's a good way to model the passive income of dividends coming in.
Yeah. And I think, the interesting thing about dividends too, is there's a lot of early retirees where the dividends that they receive, that's like a meaningful part of what they're living off of, in addition to also perhaps, needing to sell some stock. But the dividend, if they've got a large portfolio, that 1.5% you mentioned can be a very meaningful amount of what they're living off of. Yeah.
The holy grail is, forget the 4% rule, forget 3%. Like the true holy grail is you are living off of your dividends, right? Like there is nothing better than passive income. Like people talk about real estate, right? Like you are literally you're not lifting a finger.
Yeah.
And you've just got money coming into your bank account on a regular basis.
Feels like free money.
Correct. And so
it's not, it is income. You're taxed on it. You're a shareholder, right? You earned that.
Right. One thing people who invest in dividend, quote, dividend stocks, I think some people will get confused on the actual value of that. It's not like that company has a lot more value per se, right? Companies are still measured on their earnings and their profits. A dividend, a company who's issuing a dividend is deciding to share some of that, and they typically will have lower stock appreciation because they are not necessarily reinvesting in the business to grow. And so that's something you've always got to consider, that if you're investing in a company that's paying you a dividend of 4, 5, 6%, you can't expect to have much stock appreciation. Whereas if you're investing in a much higher growth company, you may not be getting a dividend, but you're going to get a lot of stock appreciation or potentially have that stock appreciation. So it's not a black and white, like one is better than the other. You can always sell shares from a company that doesn't issue a dividend in order to get cash flow.
Yeah, I was going to say, you could just make your own dividends.
Correct. They both have the same effect.
Yeah, you can decide to give yourself a dividend.
Right, your taxes is separate, right? Like the taxes are different because you have capital gains on stock appreciation versus dividends are being taxed at regular income.
Yes. Okay. So I hope that is helpful to people. That's a lot. And there's so much more we could cover. And, we may do a part 2 to this if this is.
Or even maybe we do a reader Q&A, right? Like what are the topics? What are the terms? What are the things that have confused you in the past? Maybe you can put something out. What didn't we cover here? Yeah. Put something out on Instagram, Maggie, and we can maybe take some listener questions on things that have confused them. Yeah, no, that's a great idea. But I hope this is helpful. We really appreciate you all listening. We hope this gives you a little bit more confidence and knowledge and financial acumen as you are talking to other people about money and also just on your own investing journey. We always appreciate you spending some time with us. If you have enjoyed today's episode, we love it, love it, love it. If you want to give us a written review on Apple Podcasts or a rating on Spotify, we really appreciate it. We also encourage you to share this episode with a friend or family member to encourage ongoing discussions about money. You can also subscribe wherever you listen to podcasts. If you have thoughts or questions, we'd love to hear from you. You can leave us a voicemail or text us at 404-981-3370 or hit us up on Instagram. Awesome. Thanks, Andrew. Thanks, Maggie. Bye. Bye.